There is a specific number calculable to the dollar at which every additional year you spend working is actively costing you more than it gains you. Not metaphorically, mathematically. The Employee Benefit Research Institute found that 1/3 of retirees still had 100% or more of their initial retirement assets by their mid-80s. Meaning, decades of "I'll be comfortable when I have a little more" produced decades of not spending money that was perfectly safe to spend. And the part that should make you genuinely irritated, the 4% rule you've been treating as gospel, is, in the words of Morningstar's own portfolio strategist Amy Arnott, based on a worst-case scenario designed to survive the absolute worst sequence of returns in United States market history. You've been planning your entire financial life around a catastrophe that, in most cases, never arrives. The question isn't whether you're saving enough. Most people watching this already have the number. The real question is whether your brain will let you recognize it when you hit it, or whether it will convince you that one more year always makes sense. That is what I'm going to break down here. There is a threshold. It's real, it's calculable, and crossing it without noticing is one of the most expensive decisions you'll make, not because you'll lose money, but because you'll lose time, and the two things stop being interchangeable somewhere around your 63rd birthday. Think of it like this. Your whole career, you were filling a reservoir. Drop by drop, paycheck by paycheck, 401k match by 401k match. The reservoir has a water line marked on the side. That water line is the exact level of water that can sustain you for as long as you statistically need it. When the water hits the line, the dam holds. The reservoir works. You can open the gates and live on what flows through. But here's what happens instead. The water hits the line. And because filling the reservoir was the mission for 40 years, most people keep filling. The water spills over the dam. And where does it go? We'll come back to that, because where the overflow actually ends up is the part that's going to surprise you. Check the water line. That's the frame for this whole video. Everything else is math and psychology explaining why almost nobody does it. In a few minutes, I'm going to walk you through the exact calculation that defines your waterline. But first, I need to explain why your existing calculation is almost certainly wrong, and why it's wrong in a specific direction that is costing you years of your life. There is a researcher at Prudential Financial named David Blanchett. He published a study based on thousands of actual retirees tracking their actual household spending over time that fundamentally contradicts the assumption sitting underneath almost every retirement calculator you have ever used. Every standard calculator assumes you'll need the same inflation-adjusted income every single year for 30 years. Steady, flat, constant. The number you enter on day one is the number the spreadsheet applies to year 28. Blanchett's research reveals this is wrong. Real spending follows a predictable pattern that can reduce your retirement savings needs by 15 to 25%. The research tracking household expenditures through time shows spending follows what he called a smile curve. Ages 60 to 70 bring higher spending for travel, activities, and hobbies. Ages 70 to 80 show declining spending of roughly 1 to 2% annually in real terms. And ages 80 plus show rising healthcare costs, but often lower total spending overall. In your 60s, you travel, you renovate the house, you finally have time to actually enjoy. You go to dinner more than you ever did when you were busy chasing a career. You spend more than you did while working. Then, somewhere in your early 70s, the rhythm quietly changes. Not because you're broke, because your life shifts. You stop doing 4 trips a year, then 2, then 1. A staycation starts feeling like enough. On average, a retiree with an initial spending goal of $100,000 per year can expect to experience declining real expenditures through age 84. When real spending reaches a trough of about $74,146, a nearly 26% drop in real expenditures. After this point, average real expenditures increase, though they do not necessarily exceed initial retirement levels until retirees reach their mid-90s. A 26% reduction without any financial stress driving it, without a market crash forcing cutbacks, just the natural arc of how human beings actually age and spend. Here is why that matters to the waterline calculation. Traditional retirement calculators assuming constant spending overestimate retirement needs by 20 to 30%, which means the The person who thinks he needs $1.5 million might actually need 1.1 to 1.2 million. The person who has been almost there for the last 2 years might have crossed his waterline and is standing in the overflow. The problem is that many people carry the save more mindset unchanged into retirement. The behavior that built wealth becomes the behavior that prevents them from enjoying it. They hit the waterline and keep filling. The reservoir was never the problem. The problem is they have no framework for what full looks like, so full never arrives. This is the reversal that runs through this entire video. You think the problem is you might not save enough. What the research underpinning the retirement spending curve actually suggests is that many retirees may be oversaving, possibly by around 10 to 20%. You've been solving the wrong problem rigorously for decades. Retirees relying on fixed spending rules tend to oversave and work longer than necessary. Not a little, measurably longer. And those extra years aren't a rounding error. Those are years in the early part of retirement, the go-go years, the years when travel doesn't knock you out for a week, when spontaneous decisions are still physically possible spent at a desk doing work you probably don't love for a number you already had. One recent study by 2 research fellows at the Retirement Income Institute found that 65-year-old retirees are spending, on average, only about 2% of their savings. 2%. Morningstar now says 3.9% is the safe withdrawal rate for someone retiring in 2026. That gap between 2% and 3.9% is not caution. That gap is the reservoir overflowing while people stand next to it, adding more water with a garden hose, anxious that somehow it isn't enough. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now, about the waterline formula itself. You've probably heard of the 4% rule. I want to spend a minute on the history here because the context matters. In 1994, the same year Beanie Babies hit the market and Pulp Fiction debuted in theaters, a financial planner named William Bengen published research that would become the backbone of every retirement planning conversation for the next 30 years. Bengen published his seminal research study on safe withdrawal rates, establishing that based on historical market data, a person who withdrew 4% of their portfolio's value during their first year of retirement, then withdrew the same dollar amount adjusted for inflation in each subsequent year, would never run out of money by the end of a 30-year time horizon, even in the worst case sequence of returns ever experienced in the historical US data. Worst case. That is what the 4% rule was built on. The absolute worst run of market returns in the recorded history of the United States stock market. The 4% rule was developed based on historical US market data. Back then, bonds paid around 6 to 7%, inflation was tame, and life expectancy was shorter. Under those conditions, a 50-50 stock bond portfolio could reliably sustain 30 years of withdrawals. None of those conditions exist in the same configuration today. Inflation has proven sticky and unpredictable. People are living longer, meaning your portfolio may need to last 35 to 40 years, not 30. And the 4% rule was never designed for a 40-year horizon. It was designed for 30. 2 years of working longer than necessary when you're expecting a 30-year retirement just extended your horizon toward 38. The math doesn't improve the way you'd think. Morningstar's research concluded that 3.3% was a more realistic estimate of a safe starting withdrawal rate in 2021. That number has fluctuated in the years since. In 2022, they estimated 3.8%. In 2023, as inflation forecasts moderated and yields rose, they estimated 4%. And in 2024, they estimated 3.7% due to higher equity valuations and slightly lower bond yields. Morningstar's December 2025 research announced 3.9% as the optimal rate for those retiring in 2026. 3.9%. On a $1 million portfolio, that's $39,000 per year in sustainable withdrawals before taxes, before fees. On a $1.5 million portfolio, it's $58,500. That's a livable income. For most people who have been investing consistently and watching this kind of content, that number is within reach. The question is whether they're computing it against their actual spending or their assumed spending, which the Blanchett research shows is systematically overstated. Here is where I want to introduce the fee math, because it connects directly to the waterline in a way people consistently underestimate. If returns on a portfolio over 35 years average 7%, and fees and expenses reduce average returns by 0.5%, an account balance grows to $227,000. If fees are 1.5%, however, the same account grows to only $163,000. A 1% difference in fees reduces the account balance at retirement by 28%. 28%. That's the Department of Labor's own math, not a financial blogger. The Department of Labor. A 1% annual fee difference doesn't take 28% of your contributions. It takes 28% of your final balance through the compound erosion of growth. For a $2 million portfolio, a 1% AUM fee means $20,000 per year before any fund level costs are added. Over 30 years, that's potentially $600,000 or more in advisory fees alone, not counting the opportunity cost of lost compounding. And the incentive structure is worth noting. Not with anger, just with clear eyes. Every additional year you work and save increases the portfolio your advisor charges 1% on. His fee grows automatically as your balance grows. His annual income increases when you delay retirement. The advice to keep working until you feel safe costs him nothing and gains him a larger fee base. I find this mildly funny in a structurally inevitable kind of way. Incentives point where they point. Bengen himself, recognizing that some retirees are too reluctant to spend down their principal, adjusted his recommendation to a first-year withdrawal rate of 4.7%, as outlined in his 2025 book. The man who invented the 4% rule is telling you to spend more than 4%. He looked at the data and saw the same thing the EBRI survey showed. People are hoarding well past their waterline, and the rule he built was never intended to be the ceiling. It was the floor built for the worst possible world. And the world, most of the time, is not the worst. If you follow the 4% rule to the letter, in a lot of cases, you can end up with a pretty large amount of money left after you pass away, Arnott said. There is something quietly absurd about optimizing your entire working life around a rule designed for a scenario that almost never happens, that was last calibrated to a bond yield environment from 30 years ago, and that its own creator has since updated upward because he's watched a generation of retirees underspend themselves into a worse retirement than they needed to have. Check the waterline. Here's something I want to be direct about. Knowing these numbers, the spending smile, the updated withdrawal rates, the fee math, and actually building a system around them are two very different things. I had access to this framework for years. It still took me longer than it should have to build a structure that made spending feel as intentional as saving always had. Because there's no automatic signal that tells you you've crossed the waterline. No alert that fires. No confirmation that it's okay to open the gates. That's why I built the Exit Code. It's a digital book, 8 chapters of pure research, no filler, built on 50 years of actual retirement data. It covers the dynamic withdrawal method, which replaces the static 4% rule with a framework that adjusts based on what markets actually do each year. So you're not locking in a number in year 1 that governs you through year 28. It also explains what I call the $14,000 invisible bill, the healthcare insurance gap that destroys early retirees under 65 who leave employer coverage before Medicare kicks in. Almost nobody models this in advance, and it routinely blows retirement budgets in the first 2 to 3 years. And it walks through the 58% rule, because 58% of retirees leave the workforce earlier than they planned, usually because of health or a company restructuring they didn't control. If your strategy depends on 2 more years, you need to understand what the actual probability of those 2 years being available to you looks like. It costs less than dinner out for 2 people through the link in the description. Now, let me show you exactly why the timing of your exit matters more than the absolute size of your portfolio. Stay with me, because this next part changes everything about how you should think about the waterline. There's a risk in retirement that most people don't fully internalize until it's too late to fix. It's called sequence of returns risk. And it is arguably the single most powerful force determining whether your retirement holds or breaks, more powerful than your savings rate, more powerful than your asset allocation in isolation. Here is what it means. Sequence of returns risk refers to the fact that the timing, the sequence of market ups and downs while you're making withdrawals in retirement may have a negative impact on your portfolio. Two retirees can start with identical portfolios, identical withdrawal rates, identical average market returns over 30 years, and end up with dramatically different outcomes based solely on the order in which good years and bad years arrive. Research by Wade Pfau, a professor of retirement income at the American College of Financial Services, directly quantified the impact, the compounded return in the first 10 years of retirement accounts for about 77% of the final retirement outcome. His research also shows that actual wealth and sustainable withdrawal rates differ significantly among retirees, not based on their actions or decisions, but simply due to the specific sequence of investment returns they experience. In other words, two retirees making identical decisions can end up with very different outcomes entirely due to timing they can't control. 77%. The first decade is nearly the whole game. Early losses, especially in the first years of retirement, are more damaging because withdrawals during a downturn lock in those losses, leaving less capital to recover when markets rebound. Say the market drops 30% in year 3 of your retirement, and you're withdrawing $60,000 a year. You're not selling shares at a good price. You're selling shares at the bottom to fund your life. Every share sold at a depressed price is a share that doesn't participate in the recovery. The math compounds in the wrong direction. The risk is greatest in the 5 years before and the first 10 years after retirement, a period sometimes called the retirement red zone. During this window, your portfolio balance is at or near its peak, and losses have the longest time to compound against you. Now here's where this connects to the waterline in a way that is deeply counterintuitive. Conventional wisdom says, accumulate more, stay cautious. The bigger the buffer, the better. But what sequence of returns research actually shows is that the timing and structure of your portfolio when you retire matters more than its absolute size. A properly bucketed portfolio, one where you hold 2 to 3 years of living expenses in cash or short-term bonds, survives sequences that a larger but improperly structured portfolio does not. Maintaining 1 to 3 years of living expenses in cash or short-term bonds means you don't have to sell investments during a downturn. This gives your portfolio time to recover without locking in losses. The size of the number matters less than most people believe. The architecture matters enormously, and the window to architect it correctly is not as long as people assume because of the 58%. A study of 3,600 retirees aged 62 to 75 found that 58% had retired earlier than planned. In that study, 38% cited health problems or disabilities as the primary driver, while 23% pointed to employment disruptions. These findings matter because many workers rely on the assumption that they can simply work a few extra years to make up for insufficient savings. Research from the Urban Institute found that more than half of full-time workers in their early 50s eventually leave their jobs involuntarily due to layoffs or other employer-related reasons. For those who do find new employment, it often comes with significantly lower pay. So the 2 more years strategy, the most common answer to "Am I at my waterline yet?" has a 58% failure rate. Not a 58% chance of failing to save enough, a 58% chance that the 2 years you're counting on won't be yours to spend. Your body might make the decision, your employer might make the decision, and when that happens, you exit without the buffer you were building, and you begin drawing down a portfolio that was never properly structured for drawdown because you always expected a few more years. The 2 more years argument is a plan that depends on a variable you don't control. If you're at the waterline, you're at the waterline. The reservoir doesn't get more reliable by adding water that might spill over anyway. Let me now tell you where the overflow actually goes. Because I mentioned early on that the water spills over the dam, and I want to close that loop because the answer to where does the overflow go is the part of this conversation that most reshapes how people think about the save more for the family argument. Baby boomers account for 51.8% of the country's total wealth, worth $78.55 trillion. The youngest baby boomers are now 61 and the oldest are 79. As the group ages and passes away, the wealth they have spent their lives amassing will be passed down to their children, what has been called the Great Wealth Transfer, set to transpire over the next 2 decades. An estimated $68 to $84 trillion is estimated to leave boomer hands. A lot of people watching this are hoarding past their waterline because they want to leave something meaningful for their children. That is a real motivation. I'm not dismissing it. Here's what the research says about how that plays out. Research by the Williams Group Wealth Consultancy found that 70% of wealthy families lose their wealth by the second generation and 90% by the third. 70%. The inheritance that your children receive has roughly a 30% chance of surviving intact to your grandchildren. Not because your children are irresponsible, because the skills, habits, and decision-making frameworks that built the wealth don't transfer through a bank wire. The overflow going over the dam isn't quietly compounding in your grandchildren's retirement accounts. According to Caring.com's 2024 survey, nearly 2/3 of Americans still don't have a will, meaning the mechanics of the transfer aren't even in place for most families, let alone the wealth preservation strategies needed to survive generational transition. You think the problem is leaving enough behind. Actually, the problem is that leaving enough behind is a strategy with a 70% failure rate across one generation. And the cost of pursuing it is measured in years you spent working past the waterline when the data says you were already clear. Now, I want to show you what all of this looks like as a real scenario. One person, specific numbers. Marcus is 62, spent his career in project management, solid, methodical, the kind of guy who reads the boring documents before a meeting, which is why he's watched channels like this one. He has $1.2 million across his 401k and a taxable brokerage account. He spends roughly $54,000 a year, mortgages paid off, no debt, modest lifestyle. He's been investing in index funds his entire career, minimal fees, no drama. His financial advisor ran the numbers. $54,000 divided by the 4% rule equals $1.35 million required. Round up for comfort, call it $1.4 million. Marcus is $200,000 short. The recommendation? Work 2 more years. Marcus is disciplined. He works 2 more years, adds roughly $120,000 in contributions. Markets cooperate. He arrives at 64 with $1.5 million. Here's what neither Marcus nor his advisor modeled. Morningstar's 2026 retirement income research estimated a 3.9% starting withdrawal rate for a new retiree seeking consistent inflation-adjusted withdrawals over a 30-year in retirement, with a 90% probability of having money remaining at the end of that period. On a $1 million portfolio, that equals $39,000 in the first year before taxes and fees. Scale that to Marcus. On $1.2 million, 3.9% is $46,800 per year. That's below his $54,000 spend. But here's where the spending smile math closes the gap entirely. A retiree can expect to experience declining real expenditures through age 84, when real spending reaches a trough of about $74,146. For someone starting at $100,000, this reflects a nearly 26% drop in real expenditures. Apply that proportionally. Marcus starts at $54,000. By 84, his real spending is approximately $40,000 a year. His average real spending across a 22-year retirement from 62 to 84 is somewhere around $47,000 per year. Recalculate the waterline. 47,000 divided by 3.9% equals $1.2 million. Marcus had the number. At 62, he was standing at the waterline. His advisor's calculator, using the wrong spending assumption and a slightly outdated withdrawal framework, told him he was $200,000 short. He worked 2 more years to close a gap that wasn't there. Those 2 years aren't a rounding error in Marcus's story. Those are his 62 and 63. The years when spontaneous flights don't require 3 days of deliberation. The The years when a hiking trip sounds like a vacation, not a logistics challenge. At the start of retirement, retirees spend more as they enjoy traveling, eating out, and other types of discretionary expenses. As they continue to age, retirees tend to slow down and spend less. The experiences he was deferring to a safer financial future were experiences that are measurably more enjoyable earlier. He spent the early go-go money on late accumulation. He'll spend the late slow-go money on travel that requires a little more planning. He'll never know the difference he missed. That's not a tragedy. It's just the direction the error cuts. I want to be precise here about the psychological mechanism because it's not weakness. As Morningstar's senior behavioral researcher Samantha Lamas explains, this may happen as a result of our natural aversion to losses, which loom larger in retirement when you are living on a fixed income. The endowment effect, where you value something more highly because you own it, may also be a factor. Once you retire, you're pulling money out of your own pocket for spending. It's not coming from your employer, and it feels so much more real and painful. The emotional discomfort is understandable. During working years, withdrawals often signal trouble. In retirement, withdrawals are the plan. The numbers are doing exactly what they are designed to do, but the mindset has not caught up. The brain was calibrated over 40 years to read a falling account balance as an emergency signal. In retirement, that same signal fires when you take a withdrawal that is completely within plan. You feel the alarm. Nothing is actually wrong, but the alarm feels real, so you suppress the withdrawal. You keep filling the reservoir. Blanchett and Finke's 2024 study, Guaranteed Income. A license to spend determined that retirees with assets that annuitize income spend twice as much as retirees with an equal amount of non-annuitized savings. Twice as much. Not because they have more money, because the guaranteed income stream short-circuits the alarm. When the withdrawal feels like a paycheck, the brain stops treating it like an emergency. The problem isn't the math. The math is solvable. The problem is the operating system. The accumulation mindset is a phenomenal piece of software for building a reservoir. It is the wrong software for using one. A survey conducted in November 2025 by Alvarez and Marsal Financial Services found that a majority of retirement plan participants aged 40 to 60 reported feeling extremely anxious about retirement, rating their anxiety about outliving retirement savings at an average of 4.29 on a scale of 1 to 5. 4.29 out of 5. Maximum anxiety. And this is the group most likely to be at or above their waterline, because they're the ones who have been paying enough attention to feel anxious about it. The people who genuinely haven't saved enough tend not to be on YouTube watching retirement content. The anxiety belongs to exactly the people for whom it is most likely to be mathematically unwarranted. Only 31% of Americans know what decumulation means, referring to how retirees draw down their assets to fund their lifestyles. The lack of planning may contribute to a retirement paradox. Some retirees are so worried about outliving their savings that they spend far less than they can afford. You can have the reservoir and still die of thirst if you never figure out how to open the gates. 3 practical things, not generic, specific to exactly what this video is about. The first, run your waterline number using your actual projected spending, adjusted for the spending smile, not the spending assumption your calculator defaulted to. Take your current annual spending, subtract 15 to 20%, because Blanchett's research shows that's what your spending actually does over the course of a retirement. Divide that adjusted number by 3.9% Morningstar's current 2026 safe rate. That is your actual waterline. Compare it to your current portfolio. If you're within 10% of it, you are in the conversation about when to open the gates, not in the conversation about whether to keep filling the reservoir. The second, don't mistake accumulation for security when it comes to sequence risk. The answer to sequence of returns risk, the fact that the first 10 years of retirement account for about 77% of your final outcome is not accumulate more until markets can't hurt you. Markets can always hurt you. The answer is structural. Hold 2 to 3 years of living expenses in cash or short-term bonds as your drawdown buffer. This one adjustment means you never have to sell equities at a loss to fund your life during a correction. You live off the cash while the portfolio recovers. The buffer changes the math of sequence risk more than accumulating an extra 200,000 ever will. The third, treat your go-go years as a depreciating asset, because they are. Research shows ages 60 to 70 bring higher spending on travel, activities, and hobbies, and ages 70 to 80 show declining spending of roughly 1 to 2% annually in real terms. The discretionary spending capacity decays predictably with age. A retirement plan that defers all the experiences to when I feel safe is a retirement plan that routinely defers those experiences to a version of yourself who wants them less. Front load the spending. Don't defer the go-go to the slow-go years. The money compounds, the experiences don't. Lazy investing built more fortune than crypto memes. And spending it intelligently at the right time, according to actual data about how human beings actually age, built better retirements than following a worst-case rule from 1994 and working past the waterline to fill a reservoir that was already full. Check the waterline. The water's there. Open the gates. Word count. Approximately 5,100 words. Sources cited and verified throughout. Here is the citation summary for the key facts used in this script. 1/3 of retirees still had 100% or more of their initial retirement assets by their mid-80 CEBRI. The 4% rule is based on a worst-case scenario, according to Morningstar's Amy Arnott, and following it precisely often leaves large sums unspent at death. Blanchett's research shows spending follows a predictable curve that reduces savings needs by 15-25%, and traditional calculators overestimate retirement needs by 20-30%. 6 5-year-old retirees are spending, on average, only about 2% of their savings, Retirement Income Institute. Morningstar's December 2025 research set the optimal withdrawal rate at 3.9% for those retiring in 2026. Bengen himself updated his recommendation to 4.7% in his 2025 book, recognizing retirees are too reluctant to spend. A 1% fee difference reduces an account balance at retirement by 28%, U.S. Department of Labor. The first 10 years of retirement account for about 77% of the final outcome weighed fall. 58% of retirees retire earlier than planned, 38% due to health, 23% due to job disruption, 70% of wealthy families lose their wealth by the second generation, 90% by the third, Williams Group. Retirees with guaranteed income spend twice as much as those with equal non-annuitized savings, Blanchett and Finke.